Hi folks, Nick Shaheen here, recapping the week ending in 5/22. A decent week overall, however, ended on disappointment for the Bulls at least. Disappointment why? Because mostly on the failure to fulfill the expectations or the potential, especially in the small caps. Apple did its job. However, the small caps dragged a little bit last couple of days. All right, so the disappointment is for the Bulls based on the Thursday and Friday price action. The highlight of the week came towards the end of the week, which was the Yellen speech. She said her usual things. Markets managed a 3-point pop and couldn't hold it more than an hour. If I remember correctly, on 3/18 we popped like 100 points. Way more than 3, let's put it that way, and it fueled a rally. So maybe it's the lack of conviction in the bull thesis that's causing some hesitation on the bull's part. The door has been open, meaning the setup has been positive, bullish for the weeks on end, and yet they do set highs, all-time highs, but they have the opportunity to put those highs, the older highs, behind them by a mile, and they haven't. We're still range bound, and that's why doing iron condors has been paying well. So credit sellers who know how to find ranges, like we do, it's an easy trade. You sell outside of those ranges, and we've been there for weeks. It's just rinse and repeat. So to put it in perspective, in plain simple English, in 2013, being short, trying to do bearish trades via credit call spreads, for example, was difficult and very costly. In other words, you lost money if you tried it. The setup since 2014 has been okay. It's still difficult. It's always difficult to short, but it has been very fruitful. In other words, you could have managed, if you know how to manage your credit call spreads, it's been an easy way to print money. So it's been difficult, but totally manageable into beating the markets without having too much trouble. So it is somewhat, if I wanted to put a headline, I guess, on this whole thing is bears have been lazy because we haven't been able to sustain a sell-off. But bulls have been shy, gutless, if you want to be rude about it. They've been shy about walking through that door that's been open with red carpets. All right, so what did I see this week? I see positive reactions to bad economic news. This is not very good. It tells me that it's a syndrome, perhaps, of having much hopium still built into the markets. That is market-wide downside risk, in my opinion. Hopium is not good if it's not warranted. Where's the new catalyst for higher prices? Okay, everything I see on companies, it's financial engineering. So, well, not everything, a lot of it. Also, what's to be paid attention to this week, other than Yellen, which we'll get into her, is VIX, way too low, way too fast this week on no new developments. In other words, it closed just at 12. It broke under 12 today. And let's look at it, what it looks like. What happens when the VIX goes to 12? Here's VIX. Let's zoom out to 1 year. This is where it closed today. And eyeball, it tells me this is the lowest close since here and here. And every time it comes to here, look what happens. And when this happens, markets go the other way. Just something to which we need to pay attention. Also, the transport's warning signs. This area right here, I've tried to put a red line, a box, any which way you want to draw it. This area needs to hold or lower it goes, and we're doing it from lower highs. So here we were rising and then flattening, and then now we're going lower. So this orange line is important. This circle is kind of where, we'll hit the fan, and we go to here or to here. Yeah, we either bounce out or bounce out. So twice this week we've had really red transports on really red oil days. Not good. If you can't rally when something on low oil with the transports, that's just warning signs. All right, warning signs. All right, back to Yellen. Yellen's statement, basically, all it tells me is that the rate hike is coming in 2015, and that if she does it, it's going to be a one and done, and not in June, obviously, but one and done, and it's so basically low and slow. So she's going to do the hike and say, get off my back, don't look for another one for a long time. And that's basically it. So based on that, the thesis for me is still the same. Let's leave room for a little bit of upside and take a few longs on some drops. I don't foresee any disasters unless one of the big variables breaks out. One of those shoes that are looming falls. And they have plenty of them, except the markets ignores them until they become a part of the ticker tape. We have Greek exit, which is it's going to come to a head soon enough. We have, unless they kick the can. If they do kick the can, that can rally markets. We've seen it happen recently 9 times in a row. Also, we have ISIS coming back alive as far as headlines are concerned. You read it more and more and more. I think it's pretty important to pay attention there. We have, obviously, the QE in Europe is working, but mixed results. You know, one day they say great, the other day they say don't. The one thing that's for sure is that their pedal is on the metal, pedal to the metal, so to speak, and even more. China is my biggest worry, growth in China, which is also Yellen's worry. And, you know, they've already lowered the bar to 7%. If they miss it by a lot, okay. And we also have the Japan experiment, emerging markets. We have plenty to worry about. Any which one of those can break the market. So you got to be prepared. You have to have a balanced portfolio. All right, coming into this week, I will again renew my 3 focal points: Apple, small caps, and financials. Apple, it's running against resistance. I don't short it in that case. It is a fantastic company. It has no Apple-centric issues. It is at the upper end of the range, so maybe it retraces a little bit, but it is running against resistance. 130 is where it should be trading at. However, it's extended past that this week. So Apple is important for the markets. It's a heavyweight, number one. Small caps have had open door to run through that, and they have not this week. The battle continues, I should say, and the small caps need to hold this line right there and need to break this line right there. So the last 2 candles not very encouraging. However, if they can break it, they can reach for this line and then recover higher. As long as they're higher than this area right there, markets are fine. If we lose this one, we can brace for lower prices there. I added the financials, which I can roughly look at through XLF ticker. And the reason is that usually markets like rising financials because it's a heavyweight in the markets. However, in this case, first of all, we've seen this twice before, and here if you want to argue for it. But in this case, there is a scenario where financials could rocket higher on rocketing rates, in which case markets will freak out because they don't like rising rates. It's just a long shot scenario. I just want to keep it in focus until it drops off my radar. So the ranges are holding. So what do? How do I trade? Hey, trade what's been trading, range bound. So iron condors for me, credit put spreads lower, credit call spreads higher. These are the 3 tickers that everybody looks at: the S&P, SPY, the NASDAQ, Qs, and the IWM for the small caps. If it ain't broke, don't fix it. So rinse and repeat. And you can pick on a few possible winners. You know, people like Amazon this week. I also found Starbucks as a potential breakout for next week. If it breaks out the red, hey, upside potential is up here. So debit call spreads for those bullish. I could probably wait to see a confirmation of a breakout here, but it could be too late. So if I want to risk a few bucks there, that's great. Also, Amazon seems to want to either break up or down. It's tightening. But you know, trade according to what's in the portfolio. Don't trade willy-nilly. Boeing had potential but then fizzled, so maybe you want to lean on it a little bit. I'm not so sure. So let me see here if I can show you what we're talking about in Boeing. All right, so it had potential at this orange line right there with this candle on Thursday. Friday candle broke down, so obviously disappointing. Now it goes back to needing to hold this level. The danger is if it loses this green box and comes back to this red box, is that this area came too fast. You know what they say, easy come, easy go. I don't want that to happen. I don't want to chance it. So this time it bounced off of it here. Lucky. Will it survive the second bounce? I don't know. Plus, if it gets down to here, will that be an inverse cup and handle of sorts? So, maybe picking a negative Boeing. I don't know of any Boeing-centric issues, but lottery tickets, I don't worry about financial as much as technical. So this is a relatively low conviction trade, so very small in size. But the setup has been the same. I sell spreads where I know prices are not going. And for that, the easiest trades are wherever I see range-bound trades. Also, Google qualifies for that range-bound trade. Google, let's pull Google L. You can trade either. You can see how it's range-bound, limited when it runs, and finds support when it sells off. All right, Nick, signing out. If you have any questions, you know where to reach me. I respond to all questions quickly.